Hey, old dogs, just a little reminder here. Don't forget about our Holiday Hope for Haiti campaign. We're trying to raise funds so we can, just $2,500, it's nothing, by December 15th to help bless the children of Haiti with some basic necessities for the holidays. Things like shoes, shirts, pants, socks, underwear, and toiletries. It would mean the world to these precious children. Won't you join us by donating $5, $10, $50, $100, whatever you can to help the children? All you have to do is go to our website, olddogsreinetwork.com/Haiti, capital Haiti, to donate $5, $10, whatever you can. That's olddogsreinetwork.com/Haiti to help bring hope to these very special kids. Again, if you can do it, man, it would be the awesome thing. These kids would be so thrilled. I know personally because I know these kids, and they are just blown away by acts of kindness from people like yourself. So again, go to olddogsreinetwork.com/Haiti to help out a child today. God bless you.
This episode of the Old Dogs REI Network is brought to you by Mino Studio.
In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dogs REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manacero.
Welcome to the Old Dogs REI Network. I'm your host, Bill Manacero, and this is the show where 50-plussers and anyone else who wants to join us get solid, no sales pitch real estate investing advice to help generate real cash flow. This podcast airs twice weekly on Mondays and Fridays, and if you aren't already a subscriber, go to iTunes or Apple Podcast, type in Old Dogs, spelled D-A-W-G-S, find our podcast and subscribe. Well, we've got a fun show for you today. We have a returning guest, somebody who is, I would say his shows have been some of the most listened to out of all of our shows, over 450 here. So I'm real excited to have him on. I'm talking about James Kandasamy, is a real estate investor, sponsor, and syndicator who has been in multifamily acquisitions and asset management since 2015. He has special expertise in finding value-add multifamily opportunities, and he has identified, underwrote, and overseen the acquisition process of over 1,700 multifamily units worth over $160 million, and also ran the execution of each business plan in the portfolio, averaging 20% IRR. James has a Bachelor of Science in Electrical Engineering from Science University of Malaysia and an MBA from the University of South Adelaide in Australia. Well, James, welcome back to the Old Dogs REI Network.
Hey, Bill. Happy to be here. It's one of my favorite shows.
Oh, well, thank you. You are one of our favorite guests. Your first episode was a killer, and that was June 25th, 2018, and you talked all about how you and your wife got started, and it just touched a nerve with a lot of people because it seemed like the kind of thing that anybody could do. And if you don't mind, maybe you could just kind of give us, just a little recap of your background, and
Sure.
we'll start talking more about passive investing too.
Yeah, absolutely, absolutely. So I live in Austin, Texas. I'm an electrical engineer with an MBA, and I think recently I got a CCIM designation, which is considered the black belt of commercial real estate.
Oh, congratulations! Yeah,
Yeah,
for your
thank you.
property management company too, right?
Yeah. I mean, CCIM is mainly, it's a designation which most of the brokers have it, and some of the advanced people in the commercial real estate, they like to have that because there's a lot of education behind the commercial real estate, right? So sometimes there's a lot of people who, become very successful in commercial real estate just riding the market, like what happened in the past 10 years, right? And there's a lot of people who, used a lot of theory and education behind it to become really successful. And for me, I like to have the both aspect of it, so that I learn the theory behind it. There's a lot of experts in commercial real estate, and I just want to learn from them, and that's why I did the CCIM designation. So,
oh, that's great. Was that tough? Was it kind of
it was really tough.
really?
Yeah, I'm surprised on how tough is it. The questions are cascading questions. Like one, if you get one wrong, another 6, 7 questions can be wrong. So. But it was tough. So, but I am happy I did that because it just for me as a satisfaction in learning some theory behind some of the concepts that we have been doing unknowingly, right?
Oh, sure.
And that's important for me. Yeah. So, going back to my introduction, we started buying single-family houses in Austin and San Antonio market. We started in 2013 to 2015. We bought almost 11 to 13 houses. And a lot of it were rentals, and we built up, from that 11 to 13 houses, we built up almost 400,000 of equity and move all that to multifamily, right? So, and we focus when we're buying these houses, we were focusing a lot on buying off-market deals, going direct to sellers, and skipping the MLS and all the normal stuff. Going direct to sellers, getting really good deals, and something we call as burr strategy, where we buy, rehab the property, and then we rent it out, and then we refinance it, and then we keep on refinancing it, right? So we already our single family house, we refinance almost twice or 3 times to pull out the equity, and that's how we generate our wealth, I guess, to move on to multifamily.
Oh, that's amazing. And you started with just a $50,000 home equity loan, right?
Yeah,
out
exactly.
Of your own personal home, right?
Exactly. We moved to the U.S. in 2010, and even though I moved as a senior manager, senior electrical engineering manager, right? But when we moved here, I didn't have anything on my retirement. Within 2 weeks moving here, we bought a house. So I almost spent $80,000 on the house. That's the entire saving I had when I moved from overseas to the US. And while I work as a engineering manager, I can my pay was maybe 100 something thousand, right? I can save it's very hard to save, right? Because now you are managing your entire family, you have expenses. I have 3 kids, I get stocks, right? So stocks from this company, and every time the only saving I have is whenever I sell my stocks, right? So that's a stock saving I have. Every time I have 50,000. And with 50,000, you can go for a vacation, maybe 10,000 go for vacation per year, and sometimes you go back to overseas to visit your family, and that's another 10,000. So you can only save 20 to 30,000 every year, kind of thing. That's what I feel. I mean, because we started really late in the U.S. As I said, even though my pay was good pay, but I think it's very hard to save unless you've been living here for a long time. You have a lot of money on your IRA or 401k and all that, right? So, but because we bought the house on 2010, that's the time where the house price were picking up again in the US, right? So we had a really good equity. So within 2013 is okay. I said, okay, I was trying to look at different businesses. We started doing website development. I was doing stock market, which went crazy. Every time I go to stock market, I lose this money, right? So I don't know. Stock market is like throwing money into the cloud. It disappears, and hopefully it's gonna grow, right? So
right.
It's like you got no control, right? So that's what happened to me. So what I did was I refinanced my house to pull out that equity, and I think we got 50,000 equity back from that house, and that was the launch of my buying of single family houses. And I had two options. I can buy in Austin, which is a really good market. I can buy two houses with my 50,000, right? I mean, there's this 25,000 down payment for two houses. I looked at it, and someone told me, why not you look at San Antonio? And my immediate reaction to him was like, wow, that's too far. Then he said, well, if you're getting a house, at 40,000, 50,000 per house, why not you drive to San Antonio? Then it hit me like a brick, because my thinking was really, I was being really lazy of driving 1.5 hours to make 50,000 more on the equity, right?
Yeah.
So I took that 50,000, went and bought like 6 houses, and then there's another 6 we got it almost for free, just because we were buying and rehabbing, right? So we almost had like 11 houses, and then 2 were flips. With that $50,000. So yeah, total we spent like $60,000 to buy like 11 houses, right? So, but it was a lot of hard work.
Wow.
It was a lot of hard work.
Wow. What year was that?
That was 2013, 2015. I mean, it's not like we ride the market. Even if you go back to 2013, 2015, there were no houses at $40,000 to $50,000 in San Antonio. It was like almost 100,000, right? But as I always mention, if you do things differently from everyone else, you can get deals which is different from everyone else, right? So we were like doing direct marketing, direct to cold texting, cold calling, all kind of direct marketing to sellers. And we're buying distressed houses, and we did double closing, where we take one loan and we move into another loan so we can refinance back our money back. So all that helped us to put in very little money into each of these houses. Right. So, it's a combination of buying the house at really good price, at the same time, strategy of this double loan. It gives us all these houses at really cheap price.
Okay. It's almost as if you went in there like a wholesaler,
Yeah, exactly. That's what the wholesalers do. I mean, why do wholesalers exist, right? Why do bandit sign everywhere on the road, right? I mean, people sometimes, when I was working, sometimes we think, what is this bandit sign? Do they really make money? Well, I can tell you, they absolutely make money, right? But the problem with wholesalers is they are very happy being a transactional guy. They just want to put a house, do the marketing, they put a house on the contract, and they assign it to the investor, right? So I said, okay, I'm not going to do that. I want to be the investor and the wholesaler. So I learned all their tricks, right? By listening to podcasts, reading books and all that. I hear all the tricks that wholesalers do. I said, now I'm going to be the wholesaler and the investor. So I took out one guy in the middle. So now I get the entire pipeline benefit, right, of that whole investment.
That's amazing. That's amazing. And you were right before the properties also were going up in price, even though you were getting them below market. Mm-hmm. You also were riding that wave too that came after, sort of post recession, right?
Correct. Yeah, you were riding it too. At the same time, you were also getting the price, at a really good price, right? We were getting like 67% after repair value, or maybe 70% after repair value, right? Which is really, really.
God, that's amazing.
Yeah. Yeah, absolutely. It was a wild ride, and if you look at it, it's just like 5-6 years ago, right? It's not far away.
No, it wasn't that long ago. And you leveraged sort of out of those homes, I take it. There's a certain point where you said, well, now's the time to sell. And did you kind of sell them all, or were you just, how did you sort of move into multifamily?
Yeah, we didn't sell. We just keep on refinancing, right? So we refinanced almost twice. And when we hit like 11 houses, I put all that houses into a portfolio loan on a private bank, and then we kept it. But now, I mean, we only have 2, and actually both of it in the market right now. Everything else we sold, because now we have moved all into multifamily since 2015, end of 2015.
And you moved right from there into multifamily. What was the first big or first multifamily property that you?
We bought a 45 units multifamily. After single family, we kept it, and we started buying 45 units, and then moved on to 174, and then 115, and now we are like 2,000 units right now.
Gosh, that's amazing. And do you you still have the same criteria you had when you started out, or do you have a different criteria now?
It's always the same criteria. I want to buy deals which makes me happy, right? And deals that makes me happy are deals that no one else can get, right? If I if I go to a broker and go to the best and final and do it, I mean I'm not that happy, right? Because I probably would have won the best and final, but coming out from the best and final, I have to look back and look at, hey, there was like 20 other people who didn't want to pay for the same product that you just bought, right? So
Right.
I am the highest paying guy in that aspect, right? So I didn't want to do that because that would not create happiness for me.
Wow.
Happiness when you buy things below market value where no one else can get, and that's where you make the most money, right? For you and for your investors too. So that's how we grow to this level.
Well, you make money right when you sign those escrow papers. You've already made money.
Exactly. The day we buy, and if you'll be surprised to see the appraised value when the day we close is like we get like $1 million more on paper, all out on paper, 500,000, $3 million more. So it's like you're already buying below value, and so you don't really worry about all the things that happen in the economy, and so much a buffer in between what you're buying.
Oh, sure.
And that makes for me it's all about risk management, right? Everything is risk management, right? So what is the risk when I buy a deal on a best and final, which means you're paying it very high. You're paying at the top of the market. We're probably overpaying because now you have competition, you have self bidding, you're bidding with all the other people. You probably overpay when you go to best and final, and which means that you really have to really hope and pray and think that you're lucky that market's going to keep on going up, right? So because you bought it at the top of the curve.
Right, that's
Right.
true. And some of those guys got hit real hard in this COVID economy
Oh yeah,
too.
there's a lot of people who are hard in during COVID right now, and I know people don't talk about it, but we do a lot of off market reach out, and I can see who's in trouble and who's not in trouble, and you'll be surprised to see on on the number of people that were very aggressively buying deals. And they are the one, I mean, if they're not in deep trouble because multifamily didn't really crash, but they are like struggling pretty bad.
Yeah, and didn't Fannie and Freddie, they changed their criteria when COVID hit as well?
Yeah, with the reserves, yes, and they also gave like forbearance and all that. So the forbearance really helped out a lot of people because delinquency went up, right, for everyone, right? So, but I think forbearance helped out, and Fannie and Freddie said if someone want to buy, you have to have a bigger reserves, and the other thing that happened during this time in COVID is interest rate went down really low, which means everyone who bought in the past 2 years who has this long-term loan with a high yield maintenance prepayment penalty, their yield maintenance just double, right? So they can't get out, right, because the penalty is high. The market is not very, very, very good right now, and a lot of guys on bridge loans, they are in worse condition because all the bridge lenders disappeared.
Oh man.
So all the money for rehab is dried out, right? There's no money for rehab, so you can't rehab. You have a very limited time. You have only 3 years in bridge loans, and you are under the gun right now because now every time the COVID extends, you're really worried because now you have a limit on your loan.
Well, what really impresses me is that it's almost like you have a different tune that that you're investing by, because so many of the investors I know, they kind of fall into the same sort of thing where we know we're not going to find below market, so they just assume there's no below market out there, so they're going to pay top dollar for it. Not only that, they're working on the same sort of format they were doing in 2016, where your 3-year, 5-year hold, and then you sell. Now you're buying for the longer term, right? For the properties that you buy.
Yeah, we like to go longer term. I mean, we like to refinance and do a cash out refi on most of our deals if you can do it, because why not, right? If you can get a free building or almost free building, and you have a very low cost basis, your risk is really low for your investors, right? The hardest part in syndication is always carrying all this investors' burden on the shoulder, right? Because as a GP or deal sponsor, right, we are always. I mean, I'm we take all this seriously, right? Because we do not want to lose anyone's money, and we really want to make sure we take care of our reputation and all that. So our shoulder is very heavy. So for me, because of that, I like to really do low risk deals, and low risk deals are the deals that you have a lot of buffer on it, right? And the high risk deals are the one that it's like where you go and buy from the normal channels. That's the high risk deal, because normal channel is not normal, right? There's so much of competition in the normal channels. And there's so much of education groups out there. There's so much of education things happening, syndication becoming big. A lot of investors are having this FOMO effect, because for the past 10 years, a lot of people have made money in real estate, and they start jumping in, throwing in money, right? The FOMO is fear of missing out, right? And if you read the book called from Howard Marks, where he talks about mastering market cycle, he said, the FOMO effect is what's going to cause the market to peak and crash later on. And he said everything is human nature, right? People are going to be throwing in money. The liquidity is very high. The banks are going to be lending like crazy, and that's the market peak, right? But when it crashed, the lenders become very conservative. Nobody want to invest, and that's a definition of recession, right?
Right.
So yeah, because of the risk, risk adjusted return, I would say. We always like to buy deals which make sense from day one itself, and that's important for us.
And how do you find these below market deals when so many others cannot find those deals?
That's why you have to do things that not everyone else are willing to do, right? So we, as I said in the beginning, I was looking at direct to sellers marketing, off market strategy, cold calling, cold texting. Sending them letters, and this is what the brokers do now. Even nowadays, that's what brokers do, right? They have to get listing too, so they have to survive. So they reach out to sellers through that method, and we try to do that same as well. In the beginning, I was doing a lot of it, and later on, I stopped because I started getting a lot of off-market deals direct from brokers as well. But even off-market deals from brokers, they are through off-market deals, and there's also premium off-market deals, right? Where brokers say it's off-market, but they tell to 10 other people, right?
Yeah, right.
And they just and that's worse, because now everybody thinks it's off-market, and everybody's bumping up the price, right? Off-market, right, compared to on-market, right? So I like to go with the true off-market, where It's only three of us, me, seller, and the broker. Three of us, that's it. And that's where you find the best deals. And I always look for some story behind the deal, right? What is the story? If a broker comes to me, I always ask them, why me? Why do you think I should buy this? So I try to get them to justify, so that they are just not throwing any other deals to us, right? To me, right? So yeah, look at all that concepts, look at all that psychological triggers. And a lot of times you can hear from brokers' voice itself when they call us and tell us this is a deal you should buy. Even from that voice tonation itself, you can see whether they seriously think it's a good deal or not, or they're just throwing in some numbers, some deals to you.
Right, exactly. Yeah. And they always try to make it sound like, this is you don't want to lose this one.
Yeah. I mean, once they email blast to everyone, there's two reasons, right? One, they think is okay, they're going to find someone to pay the crazy price that they promised the seller, right? That's why the email blast to everyone, right? But sometimes you get a call from brokers saying that this is a deal that we need you to look at, because you're the best guy to buy, and that is where we specialize in, because we can close very quickly. We are operators. It's just me making the decision, no other GPs, right? Sometimes you try to sell this to a group, and there's like 4 guys trying to make a decision, kind of thing, right? So yeah, all that plays into the game as well. Whether you're a local player, whether you're an experienced guy, whether you're an experienced operator, whether you're capable of closing, all that comes when you're getting a really good deal.
Yeah, I think it's excellent. Mm-hmm. The fact that you've really kind of marched to a different drummer here is I think really the key to your success. And you hold on to your properties. You've had them. You've also purchased them under market, even in these tight times, which is pretty amazing. And last time we talked, you were on our show in April of 2019, and you just come out with a book called Passive Investing in Commercial Real Estate. And I understand that book is just doing great. You've got some recognition, some accolades there.
Yeah, absolutely. Absolutely. I mean, yeah, I really appreciate you bringing me on during that time, because I think I launched the book in somewhere end of February, and I think I was on your show in April. I mean, I didn't even know how the book is going to perform. I mean, I'm not an accomplished author or New York Times bestseller, right? I mean, English itself is my third language, right? But I mean, 1 year down the road, we already sold like almost 2,000 paid copies of that book, and I've not even promoted that book.
Those are all just our listeners, James.
I'm happy for that. Yeah.
Just
Yeah,
kidding.
it's a really simple book, but it goes very deep technically, and I'm a technical guy. I'm an engineer. I can throw in a lot of formulas and numbers and all that. But the way I wrote the book is like very simple, people to understand, and it covers a lot of concept. And looking at all the reviews that I get in Amazon, a lot of them I do not know, and they are saying like there's one guy who said that I was reading this book when I was thinking of investing into multifamily. Now, 1 year later, I invested 15 in investment in multifamily after reading that book. So it gives me great happiness. And I mean, recently that book was featured as top 15 real estate investing book by Jim Cramer, the Street website. So
That is awesome. Wow.
Yeah, and I promise I didn't pay for that, right? I mean, because I didn't even know. I googled my name to see what kind of recognition the book is getting. So I'm happy with that, and I'm also thinking of writing another version of book, which is a bit more advanced, for the next level passive investors, right? Which things that I learned that I didn't cover in the first book, right? And some of the things is a bit more advanced concept, but I think it's important because syndication is becoming a lot more important and a lot more popular right now. But there's a lot of things happening in syndication as well, which I think is important to educate the passive investors.
Well, yeah, I'd like to talk a little bit about that. After you wrote the book, you said you've discovered some of these things that that you refer to as the dark secrets of syndication. And what exactly are those things? Yeah.
Yeah, I call it dark secrets because it walks the gray line between being illegal and being you're walking the line of legality, right? I mean, a lot of times, especially on the structures, right, on the syndication structure, and I didn't even know all this happening when I was writing my book. I mean, my book is a really good, book in terms of going really good into the concept of syndication, making someone who doesn't know anything to really learn about how syndication works, how to choose their first investment, how to choose their deal sponsor, right? But after I wrote the book, 6 months after writing the book, and I started talking to people, I'm listening to all this different structures coming in, different way of doing syndication that a lot of passive investors doesn't even know, right? I mean, and I feel obligated because now I did give a good textbook of passive investing, but now I said, they need to know about this aspect as well. This is very subtle, different kind of structures, and that seems to be important, right? So let me give you some of the example, right? So first of all, a concept called IRR partitioning, right? So basically, IRR is internal rate of return. It's basically how the Wall Street of commercial real estate measure investments, right? Because you can measure an investment return between two different investment options, and from that options you can, based on the IRR, you can see which one is a better investment, right? So for example, if you're doing a ground up construction, which first 2 years doesn't pay you any cash flow, but third year they pay a big amount of money, and after that continues, compared to a Class B multifamily syndication, which first year they pay money, per se there is a cash flow going in, and after 5 years you pay. So which one is better, right? No one knows unless you use IRR, right? So internal rate of return. But in the internal rate of return, in any of this return that every passive investor is being presented it, there's always something that hiding behind the numbers. So let's say when someone say IRR of 15% IRR, so everybody thinks, okay, I'm getting a 15% IRR in the end of 5 years, right? So that's what the sponsors are going to be talking about. But behind 15%, there's also risk factor. What is the risk of you achieving that 15%, right? How do you know it day zero? How do you know now when you're putting in your money into this deal? How do you know day zero that 15% is a good 15% or is a shaky 15%? No one knows about it, right? So we talk about a concept called risk-adjusted return, right? So when you talk about risk-adjusted return, that 15%, what is the risk of that 15% of producing that return, right? So for example, a deal which gives a lot of cash flow and a deal which gives a lot of back-end upside and the sales is completely different risk factor, right? So for example, when you talk about commercial real estate, let me just give you one concept before we go further, right? So in commercial real estate, the cash flow that you get is more well-defined, lower risk, higher probability compared to what you're going to be getting 5 years down the road on the back end sales, right? So if you look at any deals that any sponsor is showing you, they always talk about cash flow, cash flow, cash flow, cash flow, and then the fifth or 7 years, whatever year when they exit, they're going to say, "Oh, I'm going to give you another big amount of money coming in." And in commercial real estate, there's a very general understanding that cash flow is higher value because it's more well defined, lower risk of you getting it because it's current, right? It's the next 5 years and next year you're going to start getting the cash flow, whereas the 5 year from now is less defined, more into the future. No one knows what's going to happen. So when you look at risk, cash flow is lower risk, back end sales is higher risk, right? So because of that, when a professional commercial real estate investor invests into any deals, I'm talking the big guys, right? They always say, I'm going to pay more for the cash flow because that's lower risk. I'm going to pay less for the back end, right? So because of that fact, when we talk about IRR in any investment return, let's say 15%, a sponsor come and give you 15%. So how do you know this 15% is high risk or low risk? But if 15% you are getting is lower risk because your cash flow you're getting is a lot more compared to the back end, that makes the 15% lower risk, right? So the risk adjusted return in that case is high. So what I'm talking about is a concept called IRR partitioning, where you partition the total return of that 15% into two parts. One is called cash flow, the other one is called the back end, right? And there's a spreadsheet that I give out, right? That can calculate that, right? So basically, it takes all the cash flow, bring it to day zero, and then say what's the value right now compared to cash flow that you're getting at the sale. So in short, what's happening is we are taking that 15%, splitting into two, and seeing what is the ratio between cash flow and the back end sales, right? The bigger ratio on cash flow, that means the lower risk that you have in that return. And the same thing, if you have a bigger risk, bigger percentage on the back end sales, that's a higher risk deal, right? So when you're comparing two deals, let's say 15% on deal A and 15% deal B, you have to look at where is the 15% more consist of. Is it more consist of cash flow or is it more consist of the back end, right? So I'm not saying cash flow deals are always the best. I'm just saying, cash flow has lower risk, higher return kind of thing. And if you're doing a deep value add where there's a lot more returns, you want to make sure that, you're not looking at 15% and 15%. You're probably looking at 15% and 20%, right? Because then it makes sense to do the more riskier deal because you're getting a lot more returns on the back. But basically, the 15% on deal A, deal B, right? You want to make sure that where does it consist of, right? Is it more on the cash flow or is it more on the back end sales upside or not, right? So the cash flow is always have higher value, and the back end sales is always lower value because it's higher risk, right? So if a deal comes with a lot more skewed towards back end, that is a higher risk deal, right? Compared to a lot more skew on the cash flow, that's a lower risk deal, right? When you're looking at apple to apple IRR numbers, right? Internal rate of returns, right? But
so you're saying that an IRR, you can adjust the percentage of how you factor in back end and cash flow?
Yeah, correct. You can
Really?
use a concept called IRR partitioning where you split that IRR into two and you look at which one is cash flow, which one is back end, and then you see what is the ratio, right? So if the ratio of cash flow is much higher compared to the back end sales, that's a better deal compared to a deal which has the same number of total IRR but more skewed towards the back end.
Okay.
Right. So it's a concept called IRR partitioning. That's one of the, I think it's important concept when passive investors look for what are they going to be investing. Right. So, and in my first podcast, I talk about you always want to see what type of deal that you are looking for, right? Are you more a senior person? Are you looking at more lower risk deal? You want more cash flow? Then you want to invest more of a deal which has a higher cash flow component of it. And this calculation, the IRR partitioning method, will give you that way of calculating any deals that's put in front of you, right?
So that's
That's
Yeah.
one concept that I didn't even learn before I write the book, and that's one thing that I think is an important concept for any passive investors to learn when they are looking at different types of deals, right? Um, yeah, you want to go to the second concept?
Yeah, just a quick question on that.
Sure.
A passive investor, if they are looking at somebody's IRR figures for a deal, can they ask or do they ask, do you do partitioning, and if so, what are the percentages there?
Well, I mean, you can. I know most sponsors wouldn't even know how to do IR partitioning, so that's okay. But I think you have to look for the spreadsheet. Like I do have my own like master class that I teach this concept where you can download that Excel spreadsheet and you can do this calculation on any cash flow or any distribution that's being shown by any sponsors, right? You can just plug in the numbers and you can see where is it skewed. Is it
Wow.
more skewed? Is it more skewed towards cash flow or skewed more towards the back end?
Would you want to share that with us, with our listeners?
Uh, that's part of the master class.
You got to take the class. I know.
Yeah.
Okay.
It's like what I'm in the master class, like what I think it's like 197. I mean, that covers the entire 7 subjects of my video, and I did the last one.
Okay.
I think but you really have to go to the class to really understand the concept. I mean, I'm making it very simple, but it's good to just go through that, right? So, and if you can find that Excel spreadsheet somewhere else, you can definitely look for it. But it's a concept in commercial real
We
estate.
can put a
right?
link to your class if you want to send us a link,
Yeah,
so
absolutely.
people can take that. Yeah.
Absolutely. So the second concept that I learned that was very surprising for me was something called a change of on and off, right? So when you're treating your operational cash flow, right? I mean, when you talk about cash flow, right? So any investment, a way of investment is defined is when you put in like 100,000. Let's say you've been given a 10,000. It's called a 10% profit, right? Which means a cash on cash. So your 100,000 is preserved. On top of that, where you're making money, right? But what I've learned is some syndication structure is structured in a way where you are getting back your own money, right? You put in 100,000, the first distribution 10,000, even though it's called cash flow of 10%, but if you read the company document, that 10% is actually your own money. You're putting 100,000, you're getting back 10,000. So your remaining cost basis is 90,000. so there's a very subtle difference in company agreement, and I see that in many syndication nowadays, which I think was surprising for me because for me that is not even an investment, right? That's more of it's a quasi loan type of deal kind of thing, right? So and I just want to make sure that people understand that. Make sure go and read the company agreement. Make sure operational cash out, operational payout is always being treated as return on capital rather than return off capital, right? Because the moment they do a return off capital, that means that let's say 5 years you are investing in a deal, every year you're getting 10,000, 10,000, 10,000, even though you're being told that it's a distribution of 10%, it's a cash flow of 10%, but they'll never, the trick comes is when they don't talk about cash on cash, right? Because they know it's not really cash on cash, it's basically return of cash, right? Which means the entire 5 years you are making zero money, right? Your entire profit is being made at the sale, because now only at the sale, with the hope you're making profit, is when you're going to be making money, right? Because during operations, everything's written off capital, right? Compared to the right way of structuring deals, where if you're putting 100,000, you're getting 10,000, 10,000, 10,000. It should be like 10% on top of your money. Your capital should be preserved until the end, and at the end, the sponsor should be giving back your entire capital back, and then they do the profit split or whatever split that any sponsors want to do. So I was surprised to hear that this kind of deal structure exists, and a lot of passive investors doesn't know. I've talked to many passive investors who own thousands of dollars. They didn't even realize that that's how investment structure that they invested in. And people don't really realize all this because market has been going up all the time. But imagine market is flat, right? You're buying at value A and you're selling at value A. That means basically you didn't make any money. In fact, you would have lost money because inflation would have eaten your money, right? So
Right.
But this kind of structure do exist, and I want to make sure that any passive investors listening to these podcasts, go back and check your company agreement. What did you invest in, right? And it's very subtle. I mean, I'm not saying this is illegal. I'm just saying it's not even a favorable investment for passive investors, right? And the reason why I say I mean I'm not a lawyer or a CPA. I'm not saying it's not illegal because it is written on the company agreement, right? And every passive investor sign the company agreement. But if they don't understand investment structures, they wouldn't know what kind of investment are they making into the deal.
Yeah, because the SEC attorneys are the ones that put that together, right? I mean,
yeah. SEC attorney is going to say, yeah, you want me to do this, I'm going to do it this way, right? So, but it's more of an investment structure. Legally, everything is correct, right? But investment structure wise is not correct, right? So,
wow, these are not in your book, these concepts.
No, this is all not. I was so surprised when I hear that, and this is not like 1Z, 2Z syndicators are doing. There's a lot of syndicators are doing. So I think it's just an obligation for me to educate passive investors. Just we are doing all this for a long-term relationship building, right? So whatever we are doing is long-term, right? And the moment a passive investor realized that they were misled by certain provisions in the company agreement, even though it's legally correct, they're just not going to be happy, right? And it's one very easy way to make a very, very low risk deal into a very high risk deal, right? The deal that they buy could be low risk. They're buying at a really good price, and they're it's a really good plan. But just because of the structure of returning back their own capital instead of making profit for them during operation, because of that structure, the whole deal is high risk for passive investors. Right. So does that make sense? So
yeah, no, it does. It's interesting, and I see where it's coming from too, because as we've moved into a more competitive environment where you're paying top dollar for deal. I mean, some people go over asking price on some deals.
And, absolutely.
Yeah, and so how do they compensate? Well, this sounds like one of the ways that they're compensating, the way that they're adjusting things.
Oh, yeah, the way the sponsors are adjusting, so they make money in a different way. But for example, there was one sponsor who came and told me, James, I only take 10% of the deal. I say, why are you doing this deal? I mean, this is a lot of work, Why are you doing that? Oh, we get equity on top. I say, how do you get equity? Oh, they said as we pay them cash, their basis reduces. Wow. How do you do that? You cannot do that, right? I said, no, that's how we do it, right? So, wow, really? So the profit split model, like 80-20 or 90-10, or even on the pref return, you have to really see what is being given back. Is it capital or is it profit, right? And all that makes a lot of difference when the market's flat or market's going down, right? People don't realize when market's going up, right? But it does make a difference in terms of investment structure and the risk that you're putting into the deal, right? So, I mean, it's a very simple concept. Multifamily or any investment is, people always talk about self-storage, multifamily, mobile home parks, low risk, right? But the structure that you invest in can make it high risk.
So it's really a matter of education for the investors. They need to know and understand that some of these practices are occurring.
Yeah. And as I said, it may not be illegal because it's everything written on the company agreement, right? But you have to understand the structure itself, right? So third things, like some of the deals that I see, where people start paying out day one itself, like 8% pref return. And how do you get 8% on a value add deal? I mean, you're buying at a 5% cap rate, a 75% LTV. It's very hard to get into 8% pref unless there's some other tricks that's being done. And a lot of times it's because the sponsors are buying things deal very quickly and they want to make the investor base very happy, right? They start paying from day one, right? So like for me, I mean, I always do value add deal, deep value add deals, and we take like 6 months to sometimes 1 year to start paying out because the property is what's paying the investors. There's no other way we can get the money, right? But some sponsors, they just overraise or, they float the money, they pay the investors' face, make them happy. And, I don't know, maybe later they catch back or I'm not sure. I mean, I've seen sponsors where, they keep on buying deals, they keep on paying, but the deal is like 80% occupied. How are they paying the money, right? And at some point, because they do so many deals, and they realize that they don't have any more money to float to investors, right? And now, some sponsors are in trouble because of that, because they keep on paying money from, not from the real estate, but from other means, right? So paying day one, high return doesn't mean that the deal is doing very well. That's another education that you want to do.
Right.
And there's a few other concepts that I mentioned in my book, which is very interesting and very not in my book, in my class. And hopefully, at some point, I'm going to get to write a book about all this so that people can learn. But I think it's important for passive investors to know, because during market peak time, everybody's just going to be throwing in money, right? And this is where the danger comes for investors.
Sure. Wow, that's great information. Thanks for sharing that, James. I really think that those are some of those little subtle things. IRR is confusing enough, for the average guy to calculate. No, really. I mean, if you're going to do it over time, there's all these factors, and and you add in these little twists here, it's even more difficult for people. So
yeah. I was thinking IRR is complicated, and I mean, as I said, the people who love numbers and who think about all these concepts and all that, probably is simple enough, but I'm just so surprised to see some of the passive investors are really sophisticated. They really calculate, they really want to figure out a way to calculate their investment risk rather than just investing just because they like the sponsor, just because they like the deal, or the big numbers are being shown on an Excel spreadsheet. They really want to, it gives you a well-defined way to choose a good investment for your own profile, right? Investment profile.
This is great. Yeah. Good stuff. Really good stuff, man.
Good.
Wow. Well, James, this has been really fantastic. I think you've provided us with some good information here, stuff that they're not going to find otherwise. I think it's great, and hopefully we can get a link to your class if people want to find out more and maybe get a hold of that spreadsheet. I tried, listeners. I tried to get it, but
Well, the spreadsheet is nothing, right? As I said, in an Excel spreadsheet, you can put whatever you want and make the numbers work. But the explanation behind the spreadsheet,
I think that's
because these concepts, I don't think so exist anywhere else. Right, the way, because I'm marrying commercial real estate theory, high level theory, a pretty advanced theory into a very simple syndication model, into a very simple way a passive investor can understand. I mean, keep in mind, passive investors are more passive. They giving up control to the sponsors, right? So, but if I give them this high level investment concept into a very simplistic way for passive investors, now they have another tool rather than just listening to a nice webinar, flowery words, big numbers from a sponsor. Now they have another tool to analyze themselves and decide for themselves, right? And that's very important for a lot of passive investors.
Oh, yeah. I mean, to be able to vet on that level, we're not all engineers like you, and so if we can have the tools to be able to analyze, better, the quality of the deal and the real return of that deal, also the risk assessment, I think, which is
the
really
risk assessment, I think, is what people forget about most of the time. How do you measure the risk behind these numbers? And as I said, so many people are happy because for the past 10 years, everybody has been making money, especially like in really good asset class like multifamily.
Right.
But it's always a risk, right? Markets are cyclic, right?
Exactly.
And you always want to just self-justify yourself when you want to invest into something rather than just blindly investing.
Yeah. Well, I think you've always been a very conservative analyzer, I think, in terms of the types of deals that you actually get into. And I think that's a way to reduce risk significantly is by having that cushion there that can really prevent, because we're this economy is not over. I mean, there are things that still could happen here. We have tremendous debt. We have a lot of issues as a country, and so I think your approach is very, very wise, and that's the place I'd rather come from than trying to settle for what they're putting out there in terms of fair prices are. Because
correct.
Sometimes it's not very fair if you really do the math on it. Yeah.
Yeah, yeah. I mean, even like Howard Marks, right? I mean, he's a billionaire, and Warren Buffett is a billionaire. And if you look at Warren Buffett's return for past 20 years, I mean, he has been averaging 20% IRR, right, every year. And he's not making like 100% IRR. 20% IRR is definitely possible in apartment investing. So why all of us cannot be what Warren Buffett is, right? And I think the secret is Warren Buffett has been doing that consistently. And the way he's doing consistently is he's not looking for the top of the line returns. He's just looking for just above average return. And the way he does it is he reduces risk. You just get above average return. Then you consistently keep on doing that, right? That's how he becomes billionaire, right? And same thing, if you read the Howard Marks book, Mastering the Market Cycle, he said, he was in competition with a lot of fund managers, and he says that he doesn't want to be the top fund manager. He just want to be slightly above average, but consistently making almost the same return, right? And that's how they become billionaires, right? So risk is always a factor of any investment, and if you don't look for the highest return deals, but slightly above average return but lower risk, that's where you make consistent return, and that's how you grow your wealth long term.
Okay, great words of advice there. Thank you.
I took from their books.
I love it. Well, James, it's been such a pleasure having you on. I can't thank you enough for coming on and sharing some of the dark secrets of syndication, as you call it. I love it. It sounds like a drama here, but we have a tradition here. You know about that tradition.
I know, this is the hard part.
Yeah, this is the toughest part of the interview, actually.
Toughest part of the interview.
So come
on, the most memorable part, I guess, right? So
let's see if you can beat out your last two howls on this show.
No, this is a memory that I can never forget. So let me try, okay?
Okay.
I think that's it. Sorry for being so bad. So
it's okay.
It's some howling. So anyway,
I love it.
That's it.
I love it. That's great. Well, thanks so much, James, for being on. I really appreciate it.
Thanks, Bill, for having me. Hopefully, I add value to your listeners.
Oh, definitely. Well, I know for me personally, I'm sure they feel the same way. And I want to thank all our listeners out there too for joining us today.
Yeah. And if they want to get hold of me, I mean, just
let's. But what's the best way for folks to reach you?
So the best way is basically go back to my website. It's called achieveinvestmentgroup.com. Achieve is like achieving a goal, ACHIEVE, achieveinvestmentgroup.com. And my email is james@achieveinvestmentgroup.com. James@achieveinvestmentgroup.com. And I recently launched a campaign for my book, which I give my book for free, the top selling book.
Oh, wow.
Yeah, there's a small shipping fee, like $4 something. But if you go to this website called passiveinvestinginrealestate.com, passiveinvestinginrealestate.com, you can get the book for free.
Oh, wow. That's an added bonus here. Thank you.
Yeah, absolutely.
That's
right,
great.
so the same book is $20 on Amazon, so you can make the choice.
That's great. Wow, thank you for that.
Sure.
Awesome.
Sure.
Well, thanks again. And to all of our listeners out there, thank you for joining us. I know there's a lot of other things you could be doing right now, but the fact that you've taken the time to join us means a lot, and we really appreciate it. Please note everything James talked about today, and he gave some really good stuff here. Everything will be presented in detail in our show notes at the Old Dogs website at olddogsreinetwork.com/blog, and you're going to look for the episode with James Kandasamy. So thank you, and that's the show for today. Remember, cash flow is king and real estate investing the means. Until next time, keep moving forward and may God bless.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.